This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Welcome to the AJ Bell Money and Markets podcast, your go-to source for the latest in financial news and market updates. I'm Danni Hewson, and we've got a packed show for you today. We'll be looking at market reaction to the shock news of a general election. We'll dive into the latest UK inflation figures that probably prompted it. We'll also talk Nvidia's impressive results, BHP and Anglo American entering takeover talks, and joining me is Laura Suter.
Hi, also on the pod, we will be bringing news of the FCA's crackdown on so-called finfluencers and UK finance fraud figures. Plus, we will have an interview with AJ Bell CEO Michael Summersgill about why he thinks the British ISA is doomed to fail.
And with European markets breaking records, we hear from the co-manager of BlackRock Greater Europe Investment Trust, Stefan Gries, about why investors seem to be taking a fresh look at European companies.
First up, it will probably be no surprise that we were going to be starting with the biggest news of the week, the fact that there's going to be a general election on July 4th. As everyone will know by now, Rishi Sunak announced the election in, let's be honest, quite a soggy way. And now both parties have whirred into action to campaign over the next 6 weeks. But Danni, we'll keep the politics aside and instead let's just focus on the market side of things. So how did UK markets take the news, both in the kind of rumours to the build-up and then since the big announcement?
Honestly, it was a little bit meh. Really, in terms of since the announcement, there's not been too much reaction, and you can read into that what you will, whether markets have already pretty much priced in a Labour government because those polls have been so strong in favour of Labour, whether or not they are waiting to see exactly what is in each of those manifestos before they make their judgment, or whether or not it really doesn't matter, because the one thing that this date has done is that it's cleared a lot of the fog away in terms of when will an election happen? And of course, markets don't like uncertainty. They like to be able to plan ahead. Now, they know when it's going to happen, and that means that for the rest of the year, they can just focus on the new government getting its feet under the table, whether it is Conservative, Labour, or one of the many others standing. And also they can then look again, and the thing that is really still troubling markets is when will those interest rate cuts happen? And we know that literally in the hours before Rishi Sunak announced this general election, and a lot of people are speculating the primary reason behind his decision to go yesterday was we got some inflation figures, headline CPI falling to 2.3%, within touching distance of that 2% that the Bank of England likes, but just not quite there. And that had a significant impact on markets. The FTSE 100 fell to a 2-week low, really not liking those figures at all, despite the fact that on the face of it, a fall to 2.3% is pretty good.
Yeah, so those inflation figures were obviously the big news of the week. Is there any further detail on those that are kind of interesting or good to pick apart? I mean, food inflation particularly, that was the one that was really a blight on people's finances. That dropped considerably, didn't it? But any other bits to pick out from there?
Yeah, I mean, I think everyone expected that we were going to get this substantial fall in inflation because if you remember this time last year with the energy price cap, we were still being protected by the government, £2,500, whereas now it is just over £1,600. So clearly that has made a massive difference. You're right, food inflation has come down just 2.9% now versus, and I still can't believe we lived through this, 19% this time last year. We also had something which will certainly trouble the Bank of England. One of the reasons why it is the fact that we saw market expectation for a June interest rate cut go from 50-50 to just over 10% within a matter of minutes of this announcement was the fact that service inflation, it didn't move very much at all. And similarly with core inflation, we are talking about just teeny tiny movements. And those are the things that the Bank of England will be really looking at, because we've also seen, of course, an increase to the national living wage. We've seen people who are working get that national insurance cut coming through to their wages. And I think it's really important, we keep talking about inflation going down. There have been a lot of headlines, but it doesn't mean prices are going down. And I was looking at a figure yesterday which showed that since we started that sort of creep up in mid-2021, prices are still on average over 20% higher than they were. And if you were looking yesterday, you could have probably seen a whole shopping list of stuff, how it used to be back in 2021 versus how it is now in 2022. I mean, do you feel better off when you're going to the supermarket, when you're looking at your household budgets?
I definitely don't feel better off. I think maybe there's an element where people have got used to those higher prices to a certain extent. So there was that initial shock and everyone was saying, oh my goodness, can you believe how much a block of butter is, for example? Some of that initial shock goes away and then that just becomes the norm, doesn't it? So I'm now no longer alarmed that buying 3 things at the corner shop is always going to cost me over £5, regardless of what those 3 items are. So maybe it's just a bit of you get used to it. But no, I certainly don't feel like the household budget has improved. If anything, it's got worse.
I know that when you get to the till now, you're not sort of thinking, am I in for another really unpleasant shock? Because you're not having those same sort of, how much has it gone up by? But you're absolutely, it's not gone down. We are still feeling that. And I know we're recording this on Thursday and we get the latest UK price cap number tomorrow. And again, those sort of things should start to sort of filter through to make people feel a bit better off. But for many people, if they've got their gas and electric bills on direct debit, they've probably not seen any reduction in those direct debit payments quite yet. So, it's probably going to take us a little while, I think.
And there's some big economic news coming out ahead of the general election that could either go in the Conservatives' favour or against them. So we've got, UK growth figures, more wage growth figures. So we'll definitely cover those as they come, as well as all of the manifesto, election rumours, all of that great stuff as it relates to personal finance and markets. But let's dive into normal market news for the week. Let's talk about Nvidia. So this darling company of the stock market for a while. It just posted its latest results. It's beaten expectations for a 6th quarter in a row and has also announced a stock split. So tell us more about that, Danni.
Yeah, in the run-up to these results, there was a lot of chatter about, can this AI darling really beat expectations again? Well, yes, it could, and it did. And some of the numbers associated with this company, which is now one of the most valuable companies in the world, are absolutely astonishing. Get this, Laura, revenue up 262%, profit up 628%.
Amazing.
I mean, these are not the kind of ordinary numbers that you would associate with company updates, not year on year. But this is the power of AI. You have to think about all those tech companies or all those businesses right around the globe who are now looking at ways to implement AI to increase productivity, to be right at the forefront of what is going to be a very lucrative sector for, the likes of Alphabet. They are buying chips in the droves, and Nvidia still has over 80% of this special chip market. I mean, you need some chunky chips to deal with the kind of data that is having to be processed. Shares up so far this year, 90%. They ticked up after the bell by another 6%, taking the value of an individual shares above $1,000 until we had this stock split announced. So effectively what will happen now is if you had one share, that will be split into 10, and each of those shares is then worth the value of what that one share was worth. It doesn't impact the market value of the company. It just effectively gives investors, particularly retail investors who are thinking that they'd missed the boat because I can't afford one share, gives them the opportunity of being able to buy a teeny tiny piece of this massive company. It's going to be really interesting to see how much further it can grow in terms of its share price, but also how long it can keep on beating expectations. It reckons that with the outlook that it's still got a way to go, but obviously expectations are incredibly high.
And then finally, I think for markets this week, let's switch over to the mining sector. So this week we had the deadline for BHP to make a new and improved offer for Anglo American, which it did, and then that was then declined. But the two companies have entered takeover talks. What's the latest, Danni? Update us on that.
Yeah, really interesting, because with these final put up or shut up deadlines, which happened 5 o'clock last night, Wednesday night, we're recording Thursday just before lunchtime. If that offer is rejected, normally that is it. So you're absolutely right. BHP came back with a sweetened offer. Anglo said, no, thank you. But they have now started talking. So effectively, they've got another week to try and get this deal over the line. Now, there's a couple of really interesting bits in some of the commentary around this. First of all, Anglo is no longer saying that this bid from BHP undervalues the company. Now it is all about the structure of the deal. They're saying that it is incredibly complex. And, remember, Anglo American itself is incredibly complex. We were talking last week about some of its plans to hive off bits of itself, including De Beers, its diamond division. But it has a couple of subsidiaries in South Africa, and those are the two that BHP wants it to sell off in order for this deal to go through. And the idea is then that current Anglo shareholders would get a share in the new Anglo BHP company, but they'd also get a share in each of these other two companies as well. But 18 months, Anglo reckons, is probably a bit too tight a timeline to try and get this, particularly if you want to try and get this over the line with that kind of value which they believe that these companies represent. So we've got a week now. We'll see what happens. We'll see whether or not there can be some meaningful talks and agreement reached. I think what they do need to be careful of is that they need to make sure that they maintain compliance with takeover code, which obviously there'll be an awful lot of eyes focused on this potential deal and dotting the I's and crossing the T's of whatever happens next. And as Laura says, that's all we're going to do for markets this week, just because we've got so much other stuff to get through. We have had a huge amount of markets news. We've had AstraZeneca talking about doubling their revenues, 20 new drugs in the pipeline as part of its investor day. We've also had Nationwide shareholders giving the go-ahead to the takeover of Virgin Money, Rolls-Royce engines, saying that they have hit a really special milestone in terms of revenue generation because flying hours for its engines are back to pre-pandemic levels. We will do more markets news next week. Hopefully we won't have a snap election called. Well, we can't have a snap election called here, but hopefully there won't be anything else quite as momentous to talk about. But in the meantime, if you want more details of those, then do go to the Shares magazines. They've got some fantastic updates on there.
Let's switch now to European stock markets. So European markets, including the FTSE 100, have been breaking records all over the place. We've seen solid earnings from big name companies like AstraZeneca, Novo Nordisk, and Siemens Energy. Investors are chasing quality stocks at good value, and they've been looking again at European markets as economic data has come in better than expected, and anticipation rises that the EU and the UK central banks could cut rates before the Fed in the US. So Danni spoke to Stefan Gries, co-manager of the BlackRock Greater Europe Investment Trust, and asked why European markets have been so unloved until lately.
Stefan, I'm just going to jump straight in because we have seen what feels like a real shift in European markets over the last few weeks. There is confidence where we haven't really seen that confidence for a long time. Now, clearly, when you're thinking about European markets, there is still a bit of a lag, but do you see it continuing?
Yeah, I guess the sentiment on Europe had been quite negative, for some time, and we sometimes thought of it as the longest talked slowdown in the history of slowdown. And the reality is, the recession never really happened. And when we look at the data today, we can see an abundance of data coming through that is pointing to activity levels picking up. So, Q1 GDP surprised positively. We've got PMIs back in expansionary territory. Valuations remain really quite attractive. And then the last bit is that the earnings revisions in Europe are actually among the strongest globally. And so, when we look at all of that together, it's not a surprise to us that European markets have started to respond. And we actually think that our markets are still hated. They're really cheap, and they're starting to break out.
Yeah, they are looking really cheap. I think that's the reason we've seen so much M&A activity and why we have seen an awful lot of particularly UK listed companies making the move stateside. Do you think we'll start to see that stop, or is there still a way to go?
Yeah, I think when we look at this, there have obviously been a handful of companies that have made that decision to relist in the US. And I think it's mainly because management teams believe that they can achieve greater valuations being listed in the US. But when we step back, actually, it's really only a handful of companies. I would say that for each company that has moved, there have been several that kind of have been asked to move and decided to stay. But you're right, it's mainly a UK topic of discussion. And I think that's because the valuation discount in the UK is so extreme. And I guess for that to change, we probably need a combination of more political stability, more growth driven by investment. And hopefully we'll get that later in the year.
So, as you say, we've seen some positive data, particularly here in the UK, with the GDP figures coming in much better than anyone had predicted. We obviously have expectations now of rate cuts coming in Europe and the UK faster than the expectation is now for the US. Is that the primary driver to this sort of optimism that we're seeing on European markets, or is there more to it?
No, I mean, that's maybe one bit, but ultimately it's just that the fundamentals are coming through stronger, and positioning remains really quite extreme in terms of the underweight towards our region. I mean, we mustn't forget that ever since the war broke out in Ukraine, we've seen something like $185 billion leave our asset class. And so nobody's really positioned right now for earnings that are coming through stronger and better. And I think the more we see that economic momentum starting to pick up again, and the more markets move higher, we'll see strategists move first. And we've seen a few of them already moving overweight now, and then the money will follow as well. So there's definitely more to go.
There's been huge focus on the Magnificent Seven in the United States. Do you think that many investors wrongly assume that all the big players are in the US?
Well, I think this is a really interesting question. And the way I like to look at this is that when you look at the total capex of the Magnificent Seven, it's something in the region of $350 billion. And we get really excited by that because a lot of the businesses that we own and we can invest in Europe are actually beneficiaries of that capex spend coming through over the next few years. And I think one of the other points to make really is when it comes to the discussion between relative attractiveness of Europe versus the US is often people mistake the European stock market for the European economy. We can find a lot of growth in European companies at very attractive returns. And I guess that's where we are focusing our stock selection on.
Because we are talking about global companies. I mean, I just think about particularly Novo Nordisk. I mean, that has been a company which has just delivered some incredible earnings, and its potential is massive, and it's dominating the weight loss drug scene in the United States, even against competition from the likes of Eli Lilly. And yet the European markets just haven't received the same kind of attention as US stocks. As we start to get narratives about companies like Novo Nordisk, that has to change, right?
Yeah. So I'm not allowed to talk about individual stocks, but there is definitely an observation that some of these global leaders that we can find listed in Europe that really dominate their respective markets, they still trade at a significant discount to global peers. And we often get the question from our shareholders, how do you think about valuation? And, if a company is global and they operate in a global industry, you definitely need to benchmark it of its global peers. And obviously that includes the US. And there's a gap to be closed. And I think it's just constant delivery. And, over time, we should see that valuation gap close.
What areas are you most excited by? Because investors really have just been so focused on AI, they've been blown away by that potential. Are there other things that you are looking at right now and thinking that's where we should be focusing?
Yeah, I guess for us, we like to focus on businesses that we think of as wealth creators and where we can align that investment and that holding to very long duration investment spend. And often we actually kind of find what we think of as enablers of some of the transformational changes that are going on around us. So yes, investment in a high compute and artificial intelligence is definitely one. And the one comment I would make is that none of the big advances that we're seeing in the US today would be feasible without the semiconductor tools that are coming out of Holland, out of companies that we own in the portfolio. Other areas are areas like the energy transition, where clearly, again, Europe is leading the world with regards to technology and product on offer. And again, we know we are in the very early stages of a transition that will take a very long time and a lot of capital to come through. And then, it's things like the capex that's going into reshoring and rewiring of global supply chains. But again, some of our companies are extremely well positioned to benefit from that investment coming through in both the US as well as Europe. And we're, again, at the very early stages of a big wave of capital being deployed.
I was really interested in what you said earlier when you said that a lot of people make the mistake that the European stock market sort of tracks the European economy. But we have seen a strengthening European consumer. Do you think that now we've got falling inflation is just going to continue to grow?
That's our view. And if anything, actually, we've still seen a bit of restraint from European consumers, despite the fact that wages are growing in real terms. You have full employment in many of the European countries. And as you say, financing costs are coming down and energy costs have been coming down as well. I think the one bit that has still been missing in the puzzle, if you like, is for confidence in the economy to come back, because consumers are also impacted by all the negative headlines that we see. And I think, as we see economic activity picking up again, momentum coming back, people feel more secure about their jobs, we'll have that feel-good factor that will, help to accelerate spend going forward.
We always say that markets are forward-looking. It feels like investors have got that feel-good factor now before the consumer. Do we see that as sort of crystal ball gazing? Are they sort of on that path? Is that how it's working?
Well, to be honest, that's just the way markets work. And I've been talking on forums like this from probably September, October last year, reminding people, look, we need to be forward looking. If you just focus on the here and now and the weak data, you will be missing some of the gains that are to be had in the market. And our job is to anticipate what activity levels and the economy looks like 6, 12, 18 months out. And from here, it's all about what the economy looks like towards the end of this year, going into 2025. And again, we have the benefit of speaking to a lot of companies every week, every month. And it's very clear that we're at the end of the destocking cycle. Activity levels are starting to pick up again. And investment spend and confidence in putting capital to work is slowly coming back as well. So if you combine that with attractive valuations, we actually feel really quite good about the outlook for European markets from here.
The one thing the last couple of years has taught us is that never say never. And clearly there are still concerns about geopolitical risk. We have the situation in the Middle East. We've obviously still got the ongoing situation in Ukraine. What do investors need to consider when they are thinking long term?
Yeah, I mean, there's always things to worry about. That's, I guess, one thing. And I guess the more imminent and obvious one for us is kind of trade tensions. And I know it's very topical because it's also been in the press in the last few days. But in the run-up to the US elections, it is quite likely that we will hear more about trade tariffs or export bans being imposed. The point I'd make here is that when this happened last time around in 2018, we saw a little bit of volatility in equity markets, but the actual impact on trade flows was relatively limited. And so we could see a bit of a repeat of that, but that volatility could very well be a buying opportunity. The one bit I would point to that we see as the bigger factor to focus on is the question of whether we can have a re-acceleration in economic growth without inflation coming back. I think that's where we'll be focusing quite a lot of our work. And that's will be determining also where markets are going in the second half of this year.
Stefan, look, it's been brilliant to talk to you. Thank you so much.
I really enjoyed it. Thank you very much.
Stefan Gries there from BlackRock Greater Europe Investment Trust. Now, also in the past week, Laura, we've seen the Financial Conduct Authority cracking down on financial influencers, or finfluencers, who promote investment products on social media without proper authorization. Tell us more.
Yeah, so this announcement came out from the FCA, the Financial Conduct Authority, last week, announcing that it had brought charges against 9 individuals, and this relates to unauthorized foreign exchange trading schemes, but particularly that were promoted on social media. So it has charged a number of people. What particularly caught the headlines is that a number of those people are social media influencers, but also reality stars or former reality stars. So among them, we have people who've been on Love Island, for example, and various other reality shows. Now, obviously, there will be a court case, there will be further kind of legal action. So we won't go too deep into the FCA's actual specific case, but I think it does raise a particular area of concern, which is people getting their investment advice and their investment tips off social media, which we know is a huge source for people when they're researching investments and when they're kind of looking at where they should invest. We did some research with AJ Bell Doddle, and we found that almost a third of newcomer investors use social media platforms like Instagram or Facebook or TikTok to research their investment decisions. And in particular, I think that celebrity lure or that celebrity power is quite strong. And so we also found that almost a quarter said that they would consider buying a celebrity endorsed product. And that is really what the FCA is particularly focusing on. So not just fraudulent schemes that might exist out there on social media, but those kind of then being perpetuated by influencers, or so-called finfluencers, which is the lovely phrase for financial influencers. And I think it's just a good kind of warning sign for social media. Can be great. It can be a really good source of information where people break down jargony terms, make a lot of finance and investing really accessible. But you have to be really careful about the source of that information, how reliable it is, how accurate it is. And it might be a good kind of jumping off point, but it shouldn't be where you base all of your research, and you shouldn't rely entirely on what is said on social media. And that's kind of the rule of thumb that we have for life, isn't it? That when it comes to any area of social media, a handy tool, there might be some interesting views or kind of tips out there, but you probably shouldn't base your, entire strategy on that, whether it's investing or other areas of life. So it's really kind of just a warning sign, I think, for those that rely heavily on social media.
So easily to get pulled in, isn't it? Particularly when you've got the fear of missing out in there, and then you've got all these glamorous people making things look so enticing. But you're absolutely right. We've just got to be incredibly careful. Look, staying with this theme, Laura, we've also had updates on the latest UK finance fraud figures.
Yeah, so UK Finance is kind of the trade body for banks and building societies, and each year they gather together all of the fraud that has been reported to their member firms, so to banks and building societies, and they come out with this huge fraud report that basically looks at how fraud is in the UK. It really drills down into different areas of fraud, so we can see, the rising scams and then the ones that maybe aren't quite as popular with scammers anymore, but also the huge level of fraud that there is in the UK when it comes to people being tricked into making payments to scammers, or what you might consider a bit more old-fashioned fraud in terms of people stealing credit cards, for example, or debit cards, or even checkbooks, which obviously is not a very common fraud these days. It really kind of confirms a lot of what we know. The majority of fraud has moved online. We saw this huge leap in fraud figures during the pandemic as more people had a bit more money spare, so were more easily tricked by scammers, but also scammers just really ramped up their efforts and targeted people online because people were spending so much of their time online at that point. So the high level figures, what we've seen is actually fraud has dropped from those pandemic highs, but £1.2 billion was still stolen from the UK public. That equates to £3.2 million every single day. So we can see that this is a huge amount of money that is lost by individuals. Total fraud figures have dropped, but there's been an increase in the amount stolen through what's called authorized scams. So this is where people are tricked into sending the money themselves to the scammers. So it's things like people calling up and pretending to be your bank and tricking you into transferring money. That particular scam is dwindling a bit. But what really alarmed me was one of the big rising scams is romance scams. So Danni, do you know what romance scams are?
Oh, so this is where people who are on social media get approached by someone who says, I like the look of you, and they start talking, and then somewhere down the line they say, I've lost all my money, can you help me?
Exactly. I like that your opener would be, I like the look of you. I think maybe that shows that you're not down with the online dating, Danni, but yes, that's exactly it. It's people, often quite vulnerable people, who think that they've met a romantic partner online, either through dating apps or through social media. They think that they're in a relationship with this person, and then they, through whatever trickery, get tricked into transferring money to them. We saw a 17% increase in the amount stolen through this type of fraud last year compared to a year earlier. And this kind of fraud is now at double the amount that we saw in 2020, so kind of pre-pandemic. One figure that I found really alarming in this is that scammers go back time and time again to these victims to get more money, because once they've done the legwork of convincing this individual that they're in love with them, that they're in a relationship with them, they then find it quite easy to go back and get additional money for them. So on average, the average victim handed over money 10 times. And so that shows just how devastating it can be to an individual's finances when they get caught by these scammers. A few other things is investment fraud is still the most lucrative for scammers. So they are obviously convincing people to hand over large sums of money to invest. So whilst the instances of it might not be as high, so the number of victims might not be as high, actually, on average, each victim is handing over more money than some other types of fraud, generally because you'd invest a bit more money. So the total amount the British public lost to this has dropped a bit, and it saw an even bigger drop the year earlier, but more people were scammed out of the money. So some of this reduction will come from the fact that we've been in a cost of living crisis and people just don't have the spare money to hand over for investment. So you can only scam money out of people that they actually have to spare. And so that has kind of put a bit of a crunch on the numbers there. And then I think the other thing to cover is that the reimbursement figures. So we know that we have this kind of code of conduct among banks that they will reimburse victims. That doesn't mean that everyone gets reimbursed for every amount that's been scammed off them. So now we are at a total of 64p for every pound stolen being reimbursed to victims. That's up from 59p in the pound a year earlier, but still it means that more than a third of money that's stolen is never recovered. And lots of those victims are going to have really life-changing losses. And then we also have to kind of caveat that you have to take these figures with a bit of a pinch of salt, because we know that the official fraud figures are just the tip of the iceberg. Lots of people don't report fraud. They're too embarrassed. They don't think that there's any point because they won't get their money back or the scammers won't be caught. And so we know that while 1.2 billion being stolen in fraud is a huge headline figure, the reality is it's actually much higher than that because so much goes unreported.
Yeah, my heart absolutely goes out to anyone who has been a victim of fraud, because they are so incredibly clever. Some of these scammers, very easy to get caught out. Let's move on now to the talk about the British or the UK ISA. Jeremy Hunt introduced these plans in the budget, an additional £5,000 ISA allowance that investors could use to invest in UK-listed companies. Now, we always knew with the consultation ending on the 6th of June that it was likely that these would not be implemented until after an election. And of course, it does depend which party wins the election and whether or not these plans still fit in with whoever is in number 10. But I think it's still worth talking about them, Laura.
Yeah, exactly. And so the boss of AJ Bell, Michael Summersgill, has been fairly blunt about his views on these plans. And he thinks that these plans to further complicate the ISA landscape are unlikely to bring in the kind of cash that the government thinks will make a real difference to UK markets. So Danni caught up with him to get his views. Now, this interview was recorded before the general election announcement. So it was done on the basis that we presumed the Conservative government would be in to see these plans all the way through.
You have made it abundantly clear that you don't like the idea of a UK ISA. Yeah. Why?
Because it won't achieve what it's setting out to achieve. And if you've set an important objective, and I think that they've got their focus in the right area, you want to make sure that what you do is actually going to achieve that objective. Not only will it not achieve the objective, it actually introduces damaging complexity into the ISA arena, which is something that we've been campaigning to try and simplify. So it's actually a step in the wrong direction. So that's at high level.
When you drill down, though, you look at some of the numbers which have come out about the potential for this, because people can get an extra £5,000 to invest in UK companies. Potentially, the number on that is 4 billion. That could be a game changer, right?
Even if it was 4 billion, no, it wouldn't be a game changer. So that's £4 billion over the course of an annual subscription cycle, so over the course of a year. A lot of that, sadly, is end-loaded, as we know. People don't behave as we would like them to get optimal returns sometimes. Even if it was 4 billion, we'll deconstruct that number in a minute, but even if it was 4 billion, you're talking about in the context of UK equities, which are over 2 trillion of a market capitalisation. You're including UK corporate bonds in that as well. So not all of that money is going to go into the stock market. At present, gilts are included in that as well. So not all of that money is even going to go into driving the cost of capital down for UK companies. Even if it was 4 billion, and even if it was all going into the UK stock market, it would have the same impact on the market as a nondescript day. You see the movement in the FTSE 100, in the FTSE 250 can easily be 0.5%. Well, there you go. That's what you're talking about. And there are lots of negatives that come with the product as well. So even if it was 4 billion, I'd have those fundamental concerns with it. If you then take the 4 billion number and go, okay, how have you got to that number? People like to get a number and band it around and misuse it, which is exactly what's happening there. That figure comes from the fact that there are 800,000 people. The last time that the information was made available, 800,000 people utilised their full ISA allowance. And it is only for those people, this is a niche product, it's only for those people that this product is relevant. If somebody had £5,000 and they were looking purely to invest in British stocks and shares, say, they should do that through a stocks and shares ISA, because they then have a higher allowance and there's other things that they can invest in if they choose to diversify. But even if they wanted to just invest in British equities, they'd be best doing that in a stocks and shares ISA. So it's only for those 800,000 people, so that's how you get to the £4 billion figure. But you then got to say, okay, there's two things. What's the asset allocation of those people and what's the source of funds? Where's the money coming from? So the asset allocation, this is generally, most of those people are generally wealthy people, advised customers, they have a wealth manager managing their affairs for them. So the money is not new money that they're earning and then putting into that ISA. It's money that's being moved around, it's wealth that already exists. So where's it coming from? We know from the activity that we see on our own platform, advisors will have their asset allocation for the customer set, and then they'll use the tax wrappers in the way that they believe is most efficient. They're not going to go, okay, well, the asset allocation remains unchanged, I'll now add an extra 5,000 to UK equities because that's what the government would like to see me do. They'll move some money out of, say, the stocks and shares ISA that would have already been invested in UK equities, put that into the UK ISA to get the extra 5,000 allowance and rebalance the stocks and shares ISA accordingly. So that starts to massively erode. Now, I can't put a figure on that, but I know from I could hazard a guess, but I'm a bit more careful with my numbers than some people who like to generate these figures and band them about. That massively erodes the impact that it will have. So the 4 billion figure is like a £350 million figure that was once stuck on the side of a red bus.
So the sentiment behind what the government wanted to do here is good.
Absolutely, spot on.
How can they then do it better?
Okay, and you're right to ask the question, because it's always easy to sit here and shoot down ideas, but if you're going to do that, what's the alternative? Now, there are alternatives, happily talk through them. It's hard to see that there's one that you'd go, right, that's the silver bullet here. So I think you're in a situation where you need a package of proposals here. The two categories that I think you've got are, one, you've got people trying to incentivize behaviours, which I always think works best in this market. So different tax incentives that people have talked about. So the abolition of stamp duty on UK shares. That's one that I'm personally a fan of. There's lots of research out there to show the positive, to quantify the positive effect that it would have. I actually think about it through a very simple lens of a customer on our platform. At present, if they want to buy a UK share, the government takes 0.5% up front before they've even seen that asset in their account. If they want to buy an American stock, say, that doesn't happen. Right, well, this is about international competitiveness. You got to start by not shooting yourself in the foot. Give yourself the best possible chance by not putting yourself at a disadvantage compared to other jurisdictions. I think there's only Ireland that has a higher stamp duty rate than we do on the purchase of stocks and shares. We are at the extreme end of levying taxes on this kind of activity, and we're concerned that we've got a capital market that's not as strong as it could be. Well, come on, there's an international competitiveness angle there. What I would say about that is there's also, you've got to review these things. You can't just look at them rationally. You've got to view them through a political lens when you're talking about tax changes. That's a difficult one. Public finances are tight. Everyone knows that public finances are tight. It's about 3 billion a year of a tax take at present, and you're in a world where the Chancellor's headroom, I don't know, what was it last time? So let's use round figures. Let's say 10 billion is what they might be working with next time. You're really going to allocate such a significant chunk of that to something that's not going to win you any votes. It'll make the economy better. If you're actually doing the job rationally, it'll make the economy better, but is it going to win you any votes? It's probably not. There's an awful lot of pressure is going to come from number 10 and other places. So that one is a tough one, but that would be the single best thing that could be done. There's other things that you could do with IHT and with CGT to extend existing exemptions for AIM stocks to the rest of the UK equity landscape. So you've got those incentives that you can use. The other way that you can approach it is you can start trying to issue diktats and mandate certain activity. That clearly worries me. We're a business that's all about people taking control of their own finances. These are people who are going to manage their long-term finances, and they've been given some benefit by government to do that in the case of pension tax relief or not being taxed on gains and income within an ISA. But they're doing society a massive favour in doing that. They are making sure that they won't be a burden on society later on in life. And so I think that the relationship is already a fair one. Trying to mandate it, I just instinctively don't like that. It's that sort of very sort of directive, controlled approach to running an economy, which is just not something that I personally believe in. Those are the sorts of levers that you've got to pull. For me, stamp duty would be the best one, but I can see the political challenges that come with that, and that's not my game.
Because what you will find is investors and financial advisors, they're looking for the best returns for themselves and for their clients. And when you look at the way that the FTSE 100 has been performing versus the way, say, the S&P 500 has been performing over the last 5-10 years, you can understand why people have been looking further afield. So to shoehorn them in is tricky.
And that's the thing about the UK ISA. Although it's trying to stand in isolation and drive capital flows, as limited as they may be, into UK assets, it doesn't operate in isolation. It's part of an overall decision that an individual, an advisor or a wealth manager on behalf of their customers is making. And of course, everybody, as you say, is going to be doing that compare and contrast between what can I get from a UK asset, what can I get from overseas assets, and how should I manage that overall wealth. People as individuals are trying to do the best for themselves, of course. Advisors have obligations to their clients to make sure that they do the best for them. So even if you create this thing and it stands in isolation, it's part of an overall landscape of products. So of course people will move assets around between a stocks and shares ISA and a UK ISA. It's not going to be that you're just going to drive extra assets into the UK market simply by creating it.
And I suppose just finally, as I say, the consultation is coming to an end. Potentially, if this happens, it is more money coming on to an AJ Bell platform. Will you be offering the UK ISA?
You say more money coming onto the platform, but at what cost? So my concern about it is the confusion it causes for customers. If they would otherwise be better choosing a stocks and shares ISA. We've done some initial research that shows that customers will make the wrong choice. Some customers will make the wrong choice because there is just not that understanding of how the different wrappers operate. And so we want to take complexity and the number of ISAs out of the regime. We want to drive that down, and so we're going in the wrong direction here. If we can take all of the worst aspects of the proposal out of the UK ISA, then we probably get to the point that there's an operable product there. But it's a niche product with limited demand. I'd say literally all of the worst aspects would have to come out of it for us to go, right, that's operable, we can do that. There is so little commercial benefit to us as an organisation here. You look at it and go, it needs to be extremely cost effective to run this thing. It needs to leverage all the existing infrastructure in the industry to enable us to do that. If we get to that point, sure, I can see that we would put one on the platform and it will not be driving the P&L, it will not be getting anybody excited. But don't get me wrong, my personal views about it would not call. We're a commercial organisation. It's not my job to do that. If there's something there, we can go, okay, however great or small that benefit may be, if there's a benefit there to our customers and to the organisation, then it's something that we will do. But it's so marginal, honestly. It's let's see how we go with the consultation.
Thank you very much for talking to us.
Pleasure.
And that is all for today's episode of Money and Markets. Thank you for tuning in, and don't forget to subscribe and leave us a review wherever you listen. We'll be back next week with more financial news and expert insights, so see you then.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.